So why did your milk in your smartphone case just get significantly more expensive literally overnight? Well, most of us have absolutely no idea. But right now, the US and Canada are locked in the middle of the biggest trade war we've seen in decades. We're talking 50% tariffs, tens of billions of dollars on the line, and a retaliation clock that is ticking loudly in the background. In this explainer, we're going to break down exactly how this happened, which industries are caught in the crossfire, and most importantly for you, what this actually means for your wallet and your investments. Welcome to the Explainer. I am super excited to dive into this one with you today because this is one of those massive macroeconomic shifts that, might sound like just a bunch of political noise at first, but it has a very direct, very immediate impact on your everyday life and your portfolio. We're going to map out the real investment impacts of these unprecedented 50% tariffs, giving you the edge to stay ahead of the curve. Okay, let's dive into this. Here is the roadmap for what we're covering today. First, the 50% tariff shock. Then, Canada's counterpunch. Third, the industries in the crossfire. And finally, the investment impacts and inflation.
Section 1. The 50% tariff shock. $20 billion. Just wrap your head around that for a second. That is the massive scale of the initial action here. On August 19, 2026, the U.S. suddenly slapped a whopping 50% tariff on nearly $20 billion worth of Canadian imports. This wasn't just some minor, behind-the-scenes tweak to trade policy. No, this was a sweeping action that sent immediate shockwaves straight through North American markets.
And what's wild is how incredibly fast this whole thing materialized. The U.S. announced the tariffs on August 19th, right? Well, by August 22nd, just 3 days later, those tariffs were entirely live. And now all eyes are on September 8th, which is when Canada's retaliation officially begins. The speed of this escalation is just staggering. It leaves practically zero time for corporations or investors to adjust their strategies. Now, you might be thinking, wait a minute, don't we have a free trade agreement with Canada? Well, yes. The USMCA was supposed to guarantee tariff-free trade between the US, Canada, and Mexico. But the US leveraged something called Section 338 of the Tariff Act. It's this rarely used legal tool that basically functions as a loophole. It overrides those USMCA protections, allowing the US to legally drop these massive penalties out of nowhere. To really get a read on this volatility, we have to look at the fundamental disagreement driving it. Both sides have very different rationales here. The White House's official stance is that Canada has been unfair to American exporters, specifically in dairy, alcohol, and motor vehicles. But on the flip side, Canada's Prime Minister, Mark Carney, argues that his team was being completely reasonable and that the U.S. brought these unacceptable, last-minute demands to the negotiating table. Regardless of whose side you take, the reality for us is simple. The negotiations fractured, the tariffs are live, and the economic fallout is officially here.
Section 2. Canada's counterpunch. Over 700. That is the sheer volume of different American products that Canada is targeting starting September 8th. We're talking tariffs ranging anywhere from 15% all the way up to 50% on these items. It is a strict dollar-for-dollar retaliation strategy aimed right back across the border.
But perhaps the most impactful move of all, Canada is doubling its tariffs on U.S. steel and aluminum to 50%, which perfectly matches the U.S. tariff. Canadian officials are calling this a necessary defense for their domestic manufacturing. Economists, though, they're looking at this and seeing something way more concerning. They see the opening salvo of a much longer, much messier trade war. And the real kicker here? There is absolutely no expiry date. Both sides are just digging their heels in.
Section 3. Industries in the crossfire.
Now, what's really interesting about how these tariffs are structured is a pretty wild quirk. The U.S. tariffs cover this massive range of goods, but despite one of the lists literally being labeled motor vehicles, it actually contains 0 cars, none. Instead, that specific list targets electronics, furniture, building materials like lumber and cement, plastics, clothing, footwear, toys, the whole shebang. So the blast radius, it's incredibly wide. It's hitting way more sectors than the headlines might have you believe. And the damage, it is already highly visible. Using data straight from the Bank of Canada, we can see the devastating immediate hit on key Canadian exports compared to 2024 levels. Since this all escalated, Canadian steel exports have basically been cut in half. That's a 50% drop. Aluminum exports are down by about the same amount. And lumber exports have taken a 20% hit. These are foundational industries taking massive blows right out of the gate.
So for everyday consumers, this translates directly into a serious squeeze at the cash register. You can expect heavy price pressure on dairy and alcohol, which remember were the direct targets of the original U.S. complaint. You're going to see it in home goods and furniture, because Canada is a huge supplier of lumber and building materials, and you will absolutely see it in anything metal-heavy. Think appliances, cars, construction. Why? Well, when you slap tariffs on steel and aluminum, you raise the core input costs for manufacturers on both sides of the border.
Honestly, this quote from a trade lawyer hit the nail on the head. Nearly every industry is going to feel some downstream effect from this, even if it's not obvious at first glance. It's like a giant puzzle, right? Everything is connected. When foundational materials like metal and lumber get hit with a 50% tax, those costs are going to ripple all the way down the supply chain.
Section 4, Investment Impacts and Inflation.
Okay, here is the part you actually came for. Let's shift gears and break this down into a master list of the 4 money takeaways. We're going to look at inflation pressure, sector volatility, domestic metal tailwinds, and the slow-moving timeframe of this whole conflict. Let's dive into these one by one.
Takeaway number 1, inflation pressure. As an investor, you have to remember that at the end of the day, tariffs are a tax, and companies, they almost always pass at least a chunk of that new cost directly on to you, the consumer, to protect their own profit margins. So over the next few months, expect your grocery bills, cars, and home goods to creep up in price. If you're trying to model out inflation expectations for the broader market, you've absolutely got to factor this new baseline in.
Moving on to takeaway number 2, sector volatility. Companies heavily reliant on North American supply chains are already feeling the heat. Automakers, construction firms, packaging companies, they are already flagging this specific trade uncertainty in their SEC filings as a very real risk to their earnings. So if you're holding stocks in manufacturing, autos, or industrials, brace yourself for some turbulence. The market hates uncertainty, and right now those supply chains are just full of it. But hey, it's not all doom and gloom. There is a potential silver lining here, which brings us to takeaway number 3, domestic metal tailwinds. Steel and aluminum producers based right here in the U.S. could actually benefit in the short term. Because foreign competition just got vastly more expensive, domestic companies might see a real pricing tailwind. They can potentially raise their own prices or gobble up more market share. If you're keeping an eye on domestic industrial plays, this space is definitely worth watching. And finally, takeaway number 4, which is crucial for your overall strategy, understanding the slow-moving time frame. Look, this isn't some one-day event that you can just trade around and forget about. Remember, Canada's retaliation hasn't even fully hit the data yet. We are likely looking at multiple rounds of escalation, maybe some negotiations over exemptions, and just ongoing headline risk for weeks or even months. This is exactly the kind of macro event that rewards patience over panic. Don't go making sudden, sweeping changes. Adjust your risk profile with the understanding that this is a long-term standoff.
Which leaves us with one critical question to wrap things up today. How is your portfolio positioned for a borderless trade war? The U.S. just slapped a massive tax on billions in goods. Canada is firing right back. And honestly, there is no end in sight. The impacts on inflation and industrial volatility, they are already underway. This story is far from over, and truly understanding these details is the best way to grasp the reality of the situation. If you want to keep mastering these complex topics and stay ahead of how global trade moves impact your wallet, be sure to join us for future explainers. Keep learning, keep analyzing, and I'll see you in the next one.